property owners get the shaft. Remember Proposition 13? Utahns can do it too. And Utah has consistently taken top ranking in bankruptcy rates. Further, bankruptcies during 2007 showed a 25% increase. When the system is broken, I think it's about time that someone starts to use common horse sense. Ladies and gentlemen, the traffic signal is locked in a red condition. Does the county really take the public to be dumb? So far, all we've heard is that it's the legislature's fault. Bzz. Wrong. Not so. Not when you have the effective taxation tool. Not so when judgments can recognize and fix broken systems. The safety valves are clearly there. They are not being used. Take a look at your 2007 property taxation notices. It uses an unprecedented low effective taxation figure of just 0.65. No past effective taxation we've tracked has gone this low. It is simply to hide the shocking property valuation that has been raising public ire to boiling. Scanning many properties in our area, we note that most show a tax decrease. Ours didn't. What the residents may not have noticed is that their property valuation went through the roof. In the case of our 584 property, 2007 property valuation shot up an incredible 19%. And in 2006, an even more astounding 27%. A property valuation increase of 46% in just 2 years. A 486% tax increase in just 12 years. Are these, or are they not, insane tax increases? Stir in a broken taxation system, and you have chaos. You have runaway taxation because of exploding property valuation. $60,600. That was the valuation increase in 2007 for our 584 property. $60,600. We paid just $28,500 for the home brand new. This means that in one single year, our home valuation rose by 2.12 times over our original purchase price. A 2.12 times increase for an old 45-year-old property which is already depreciated and ready for the wrecking ball? This kind of inflation is simply criminal. This 2.12 times increase happened when homes around us had property tax decreases. Take a look. Here's our map again. 584 in the middle. 588, that's the one to the northeast of us. It had a property tax decrease of $28, property valuation increase of 16%. The one directly east of us, 579 East Capitol Street, had a tax decrease of $72 with a property valuation increase of 14%. Let's take a look at the Millionaire's home, which is to the southeast of us, John Williams' home, who owns the gastronomy chain of restaurants. He had a property tax increase of $10.75 with a property valuation increase of 17%. The home directly north of us, 588 Cortez Street, had a tax decrease of $48, but a property valuation increase of 13%. Let's take a look at the property to our south, 564 Cortez. There's a vacant lot in between us and that property. Had a decrease in tax of $73, but a property valuation increase of 14%. Let's take a look at the home to our southwest, 577 Cortez Street. It had a property tax increase of $3 with a property valuation increase of 17%. Let's take a look at the one directly west of us, 583 Cortez Street. Had a property tax increase of $102.83 with a property valuation increase of 23.41%. Well, I can sort of understand that. That property underwent quite a bit of remodeling, quite a bit of improvement. In fact, continual improvement over maybe the last 20 years. And let's take a look finally at the other property, which is to our northwest, 587 Cortez. Had a property tax decrease of $102.34 and a valuation increase of 11.5%. So, how did 584 fare in this little ordeal? 584, our home, had a property tax increase of $38 and a property valuation increase of 19%, and we have made no improvements to this property. There you have it. $584, $38 increase in property tax with a 19% increase in valuation. The one exception is the 583 Cortez Street, which has been extensively improved with a new large garage and shop structure built in the rear. With such an addition, one can understand that maybe the property valuation should go up a little bit. In contrast, 584 has had no major improvements over the years. Indeed, this effective taxation rate is quite magical. Spirit of the law dictates that people have a right to keep their home. Losing their home violates the very basic principles of taxation law. Much of the judge's time was spent examining rent income. Considerable time was used up in the last appeal session discussing GRM and rent income. We flatly reject the GRM figures supplied by the county. Further, rent income is simply a myth. GRM is idealistic. It's sales promotion talk. It's used to sell property. It does not reflect the true rental market state. It is worthless data when discussing actual rental income. GRM takes absolutely no account to the bad tenants who skip out, a vacancy or of downtime for property repairs or improvement. Further, it's only a sales tool to sell property. Owners lipstick a home and jack up stated rents to sell their properties. Worse, GRM is based on erroneous past garbage in, amplified garbage out valuations, which have multiplied error year after year to allow property values to escalate to unprecedented and totally unrealistic valuations. GRM is not a good yardstick to use for property valuation. Further, the county puts great emphasis on the fact that rental rates had increased using third-party information, again citing the GRM. Bzz, wrong. Personal observation in our area indicates that over these past 12 years, rental rates have dived. Homes once peaking near and over $1,000 rent have since plummeted to well below this figure. Our duplex renting at $850 a month is on the high side. Our data shows that 3 other properties rent at $650, $750, and $495. One property directly west is renting at $0. Another to our immediate south is renting at $0. Another to our southeast is renting at $0. They are vacant. The mathematical average for these homes comes to $316 a month. GRM fails completely to use or incorporate this data. Actual data shows affordable rent in Salt Lake City is $714 a month in December of 2006. Go back a year and it was $650. This is the one we used to compare the 2006 valuation. This is much less than the $850 per month rent figures cited by the county. Additionally, the Deseret News reported it's getting tougher for a family to pay rent. The cost for housing is outpacing salaries. A household must earn $13.04 an hour, 253% above the minimum wage, in order to afford rent. A national report reinforces what Utahns already know. Finding affordable housing is hard and getting harder. If you'll note, affordable rent hinges on income, but income in Utah has stagnated for the past 6 years. Factoring in inflation, income in Utah has declined. This adds considerable serious doubt to the county's figure that rents have increased. Our research shows rents have declined. As long-time landlords and from personal observation, rents have decreased in response to stagnated income. At $13.27, Utah's median hourly wage remains lower than that of the nation and of other western states. Additionally, the report states that 80% of Utah workers have actually lost ground when their earnings are adjusted for inflation. Nationally, men's wages have risen only 1.1% since the recovery period began in 2001, while women have seen a 5% growth. In Utah, the real median wage for men has fallen from a high of $17.29 in 1981 to $15.04 in 2006. Jared Bernstein, an economist for the Economic Policy Institute State of Working America report, shows stagnant wage growth for low and middle income workers throughout the United States. Hourly wages for middle income workers increased a mere 3% between 2001 and 2003, with virtually no growth in the past 4 years. A 3% wage increase from 2001 to 2003 and zero wage increase for 2003 to 2007. Isn't there something a bit wrong? Our property tax increases are averaging 41% per year. Wages increase by 0.5%. And lest this not be forgotten, we are on fixed income. Translated, fixed income equals declining income because of outrageous medical and inflation increases. So let's see. Property taxation rises at a doubling rate of every 5 years, while wages are actually in a decline over this same period. Anyone who can sit at the judging bench and say, "This is okay," can't be credible. Further, anyone who tells the homeowner to go somewhere else is bypassing moral, personal responsibility. The aged cannot just go somewhere else. And please, don't forget your own family, your own children. You are passing sentence on them by ignoring a monumental taxation problem that is and will affect not only you, but your family and future generations. Instead of using imaginary sales sheets, let's look at fact. Pencils ready? In 1962, rents were determined by using this formula. 1% of the property valuation determines a monthly rent. Using this formula for 2007 results in a rent of almost $1,900 a month. Our rent as of 2007, $850 a month. A loss of $1,045 a month, or $12,540 a year. According to this formula, we are subsidizing our renters at the rate of $1,045 each and every month. But let's step away from the formulas and do the actual calculation for rental income. We'll use the 584 property as our example. Valuation, $318,300. Our rental unit then is the loan to the renter of 1/2 this total property valuation of $318,300, or $159,150. Using the current loan interest rate of 8%, this means interest on $159,000 is about $1,000 each month. Thus, we are loaning our renters $159,150 in order to put a roof over their head. Now wait, our rent is what? Our rent is $850, and we are giving the renter a loan of $159,000 valued at over $1,000 a month. We are subsidizing our renter. $211 is what we subsidize our renter just for the cost of the loan, of the money. We are paying our renter $211 a month to live in and on our property. Oh, but wait, we forgot something. There's a whole lot more than just loaning $159,150 to a renter. As landlords, we also pay property tax at $101 a month, pay home insurance at $25 a month, pay water bills at $32 a month. We have vacancy and downtime for repair, $102 a month. We have bad renter insurance at $37 a month. We have yard care and snow removal at $65 a month. We have to routinely replace flooring, washing machines, and dryers at $12 a month. We have painting, plumbing, and miscellaneous repairs at $125 a month. We have to replace furnaces, water heaters, roof, disposals at $72 a month. We pay federal and state income tax at $91 a month. We have to pay utilities during vacancy and repair downtime at $15 a month. Remodeling and updating, $127 a month. At this point, we have 12 items in our expense column, $815 monthly. Add to this the loan amount, and we get almost $1,900. At this point, we have $1,875.52 in expenses. We get a rent of $850 a month. This then is 850 subtracted from 1875. Our net income then is a loss of $1,025.52 every month. We pay our renters to stay in our duplex. A grand total of $1,875.52 each and every month of true expense. Not expense speculated. Not expense on paper. Not expense using garbage in, amplified garbage out. This is real, tangible expense. We are subsidizing our renters at the rate of $1,025.52 per month. Our renters cost us $1,025.52 each month, or $12,306.24 each year. And you call this rental income? Renting is such a good buy right now that in no time in Utah history has the rental market been so full. Affordability is squeezing people out of the single-family home. This according to Seth Rossau, an apartment specialist with the C.B. Richard Ellis Company of Salt Lake City. According to the surveys, the current apartment vacancy rate in Salt Lake County is at 1.66%, which Rossau called ridiculously low. I've never seen a 1.66% vacancy rate in any market that I've ever researched, he said. It's pretty much the lowest vacancy that I've ever heard of. People are being squeezed out of their homes and are now seeking the more affordable, renting, with landlords subsidizing their rents. Landlords are forced to subsidize renters. Landlords are forced to absorb the losses forced upon them by the county's faulty garbage in, amplified garbage out. We as landlords are paying 55% of the total rental costs, while the renters pay only 45% of the total